Welcome, curious minds, to another deep dive. Today, we're plunging into something pretty important. It touches nearly everyone with a retirement account, like a 401k. Our sources are suggesting Wall Street's making some pretty significant quiet moves that could expose your hard-earned savings to new substantial risks. So our mission today, we want to unpack exactly what these tactics are, what risks do they pose to your retirement, and most importantly, what you can actually do about it. You probably haven't heard much about this yet, and honestly, that's exactly why we're doing this deep dive. Let's get into it. Okay, so let's start unpacking this. The strategy itself. Our sources reveal this concerted push by major money managers. Goldman Sachs seems to be right at the front. They're launching new private credit products, specifically targeting retirement plans. And it's not just Goldman, right? We're seeing firms like BlackRock, Invesco. They're also really focused on growing their private asset operation.
Yeah, that's right. And what's really fascinating, I think, is the why behind it all. The motivation, it seems largely driven by this idea of ever-shrinking public markets. That's the phrase they use. So basically, fewer companies are going public or they're waiting longer, which means these big firms, they need new places to invest and, frankly, new ways to generate revenue. They're looking for new pools of capital to tap into and ultimately, yeah, to make more money. The sources are quite explicit. These private asset products are more lucrative for them, higher fees, bigger margins. And the emphasis we found, it really suggests this isn't primarily about helping you grow your retirement. It's more about, well, the sources say, squeezing everything they can out from you.
Wow. So it sounds like it's being packaged maybe as a great opportunity for Main Street, for the average investor.
That's the potential pitch, yeah.
But the reality might be different. Okay, so that's the why. Let's talk about the how. What exactly is this private credit they want to put in our retirement accounts?
Right. So private credit, essentially it's loans made directly to companies, but not by banks usually. These are non-bank lenders, think private equity firms, specialized credit funds. And the loans themselves, our sources describe them as, well, risky debt. Sometimes some of the most opaque, high-risk, hard-to-sell loans in the system.
Opaque, hard to sell. That doesn't sound great.
No. Unlike, say, a public bond that trades on an exchange, these are private deals. They're not standardized. Valuing them is tricky. Selling them quickly is even trickier. And these lenders, they're often called shadow banks. It's a term that popped up a lot after 2008. As regulations tightened on traditional banks, these non-banks grew massively to fill the gap, but they operate under, let's say, different kinds of oversight.
Okay, that makes sense. But then the big question is,
Yeah,
how are they suddenly able to push these into retirement plans now? What changed?
that's a key point. The sources point to a period of loosening regulation and new regulatory openings. Apparently, some changes, particularly around the Trump administration era, led to what analysts called the largest rollback of financial regulations in a generation.
Ah, okay.
And this created openings. Specifically, the vehicle they're using is often something called a collective investment trust, or CIT.
CIT.
Yeah, and this is crucial. A CIT is not regulated by the SEC.
Not the SEC. Who regulates them then?
Bank regulators.
Mm-hmm.
Often the very types of institutions that, might stand to profit from these new products. So the practical result for you, the investor, is potentially less regulatory disclosure, definitely less oversight focused on investor protection compared to, say, a mutual fund. It just makes it much harder for you to really know what's inside your retirement portfolio.
You know, the way you described it earlier, these risky loans being packaged up, pieces pulled out, put in a new bundle, packaged as something different, and then sort of snuck into your retirement.
Yeah,
It sounds eerily familiar, doesn't it?
it does.
The sources draw a direct line back to 2008.
They absolutely do. That process, securitization, pooling loans, and slicing them up, it's not inherently bad, but it can obscure risk. And the concern highlighted is that, similar to the lead up to the financial crisis, complex structures might be hiding the real risk of the underlying assets, especially when they're put into accounts meant for long-term, stable saving, like retirement funds.
So if we connect all these dots, the motivation, the mechanism, what's the bigger picture here? What are the main worries about the unseen risks? the potential impact?
Well, the biggest concern that comes through is that Wall Street might be essentially setting you up to take the fall for their risky bets. That's pretty blunt language from the source.
Setting you up to take the fall. Wow.
Yeah. The warning is, look, if there's a significant credit crunch or an economic downturn, and some sources suggest one could be brewing, you could see a wave of loan defaults. And in that situation, because this stuff is in your retirement account, you, the individual investor, could be left holding the bag.
Jeopardizing everything you've saved.
Potentially, yes. It shifts where the ultimate risk lands.
And there's something else here that seems really important, maybe even alarming. Our sources stress that unlike stocks or bonds, private loans aren't marked with a real value in real time. What does that actually mean for an investor?
It's a huge point. It means the value you see on your statement might not reflect the current market reality for those loans. If things start going sour, if the underlying companies struggle, the value of those loans in your portfolio might not drop immediately or not accurately.
So you might not even know there's a problem?
Not right away, no. There can be a lag. This lack of real-time transparent pricing, it really echoes the situation before 2008, right?
Yeah.
Where problems were festering beneath the surface for a while before the true scale became clear to the public. It's about information asymmetry. The managers know more than you do.
And it gets wider too, doesn't it? Our research showed these private credit firms are moving deeper into the vast universe of asset-backed finance, funding things like mortgages, credit card loans, and auto loans, stuff that touches the real economy. What's the worry there?
The worry is interconnectedness. The financial system is complex. Things are linked in ways that aren't always obvious. The sources specifically flagged concerns about rising auto loan delinquencies and high credit card debt. These are everyday consumer debts.
Okay.
If those sectors go belly up, as one source put it, the knock-on effects could ripple through the system. And if your retirement fund is holding securities backed by those kinds of loans, especially opaque ones, well, you could face significant problems. It connects Main Street debt stress directly to your retirement portfolio's health.
It seems pretty clear from our analysis, then. This isn't just about offering you new investment options for your success. It looks a lot like firms grabbing an opportunity, thanks to regulatory shifts, to make money from private credit in ways they couldn't easily before.
That's certainly the strong implication.
They'll probably pitch it as the best thing since sliced bread.
Absolutely. You'll hear about diversification, potential for higher returns.
But the consistent warning we found is, beware of higher fees and more risk to you.
Exactly. More risk, less transparency, higher costs. That's the trade-off that might not be immediately obvious.
Okay, so this is all quite heavy. Given everything we've discussed, what does this actually mean for someone listening? What practical, actionable steps can you take to protect yourself, or at least understand your exposure?
Right, the what now? The most crucial piece of advice, repeated across our sources, is simple but vital. Know what you're investing in. Really understand your retirement portfolio. Don't just glance at the statements. You need to be proactive. Ask questions.
What kind of questions specifically?
Ask your financial advisor or your plan administrator. Are there any collective investment trusts, CITs, in my 401k or retirement plan? Ask. Am I exposed to private credit? Are there other alternative, less liquid or opaque assets in there? Get specific. The core message is, don't invest in things you don't understand. If you can't get clear, simple answers about what something is and what the risks are, that's a red flag.
Okay, so understand what's in there. What else? The sources also seem to push for diversification outside the usual system.
Yes, that came up quite strongly. Beyond just understanding what's in your current plan, consider diversification strategies that aren't entirely reliant on the traditional financial system.
What does that look like?
Well, the sources suggest talking to expert analysts, people who can help you build a strategy that might include assets outside the typical Wall Street offerings. Specifically, some sources mention considering physical gold and silver.
Physical assets, not just paper.
Exactly. They framed it less as a primary investment and more as an insurance policy against this. Against what the crooks are up to out there was one phrase used.
These are the wrong words.
Yes, but the idea is it's potentially an insurance policy against a failing dollar and a failing system. It's about having some assets whose value isn't directly tied to the stability or the integrity, perhaps, of the conventional financial institutions and markets. A hedge.
That makes sense, having something tangible outside the system. Well, this deep dive into private credit, creeping into retirement accounts, It certainly gives us, and hopefully you, a lot to think about. It's a really powerful reminder, isn't it? Just how complex and, frankly, how fast the financial world evolves, and how critical it is to be an informed, active participant in your own financial future.
Indeed it is. And this whole situation, it really prompts a bigger question for all of us, I think. In a world where financial innovation seems to constantly outrun the regulators, how can individuals really make sure their long-term savings are safe? Not just safe from normal market ups and downs, but from these less obvious, maybe hidden shifts in how big institutions manage risk and, let's be honest, how they monetize it.
How do you protect yourself when the game itself might be changing? That is a truly thought-provoking question to leave you with. Thank you so much for joining us on this deep dive. We really hope this exploration has armed you with some knowledge, helped you know what questions to ask, and maybe what steps to consider for your own financial well-being. Until next time, keep digging for those insights.